I'm your host, Ravi Gupta. Today, we're going to discuss a topic that everyone loves, tax savings. And we aren't talking about small savings here. We're talking about savings that occasionally approach 100% write-off of your entire investment in year one. Well, the question is, how do you do that? And that's by using cost segregation and rapid depreciation techniques. So to explain that, today I'm pleased to introduce Roger Hibbs. Roger Hibbs is the National Director for O'Connor Associates Federal Tax Reduction Division. Roger has a combined 24-year experience in commercial real estate and has been dedicated to federal tax reduction for commercial property owners since 2005. Roger spent 13 years in commercial property management and the past 11 years with O'Connor and Associates. Thank you for joining us, Roger.
Thank you for having me. I appreciate the opportunity.
Absolutely. And to those of you who can see the screen here, you may notice Roger's background. I thought it was a virtual background, but that's his actual library. He just mentioned to us. He's got about, 1,000 books that we can see right here, probably more.
Total's about 2,500 right now.
2,500?
But don't tell my wife.
Well, that's amazing. Well, maybe you can imbue some of that knowledge to us as we are talking about cost segregation and rapid depreciation. So let us start with that question. What is cost segregation and how does it affect the average investor?
Sure. Cost segregation has been around for a long, long time. Originally, in its earliest incarnations, it was called component depreciation, and the rules have changed multiple times. The current incarnation of cost segregation was brought about in 1987 by a lawsuit with a big hospital group, Whiteco, that sued the IRS because they were forced to depreciate items that only lasted a few years, over 39 years. And they said, that's just not right. That's not fair to us. So they sued the IRS, and the current iteration of cost segregation came out of that lawsuit. And what has happened over the years is that the IRS has developed a list of anywhere from, I think it's around 125 to 130 items now that they agree can be depreciated more quickly than either 39 years for commercial assets or 27 and a half years for multifamily assets, residential multifamily assets. And that's what cost segregation is and does. It's a way to identify those particular parts of your building that the IRS says can be depreciated on a much shorter depreciable life. In general, it's 5-year, 7-year, or 15-year in most multifamily and commercial applications. There are a few other specific applications for farm and ranch or for other types of properties where there can be 10-year, there can be 20-year, but for 99% of the investors in multifamily, especially, it's the 5, 7, and 15-year pieces that we bring to you in a cost segregation study. And in a nutshell, what we do is simply go to the site and we look at your asset. We do a thorough inspection, take pictures, take measurements, et cetera, and then utilizing an IRS-approved industry standard software, we can value those items that we see that are there out of that list of items that can be short life, and we can provide a breakout for you of the value of each of those items, and then we can show you how to depreciate it over a 5-year period instead of 27 and a half, or a 7-year or a 15-year period. So you're front loading your depreciation in the earlier years of your ownership of the asset. And as most of you know, typical multifamily investors only hang on to an asset for 3 to 5 years. So during that time span of your ownership, you're getting a tremendous amount of depreciation up front. To make it even sweeter, the 5-year items that can be identified and depreciated over 5 years are depreciated at a 200% declining balance, which means that even within the 5-year period, it's all front loaded so that you're getting a majority of the depreciation in the first few years. Same with the 7 at the 200% declining balance, and the 15 years at 150% declining balance. So again, pushing so much of your depreciation into the first years of your ownership of the asset. And in most instances, you're about ready to roll out of that asset and move on to your next deal. in that 3 to 5 year period. So you're really benefiting from the depreciation. And historically, it's always existed, but as I said, different names at different times. And cost segregation, specifically as we know it today, started January 1 of 1987.
Interesting. And why even depreciate an asset? So some of our investors ask this. Well, hey, you're investing in a real estate asset. It's supposed to appreciate over time. So why is there this depreciation aspect?
Certainly, you hope it appreciates. I mean, that's why we play the game. We want that appreciation over time so that when we roll out of it, we're actually getting some cash out of it. But remember that there is an expected life for any item, whether it's a 2x4 piece of wood or a roof shingle or an air conditioning system. And there's going to be an appreciation in the intrinsic value of your investment, the value brought by being able to lease up the units at a certain price and operate the unit at a profit on a monthly basis. But at some point, if you hang on to the asset long enough, you will need to replace some of those 2x4s. You will need to replace some of the roof panels or shingles. You'll need to replace the AC system. Of course, we're always replacing light bulbs and doing carpet replacements if we have carpet when there's a turn of the unit, et cetera. So the depreciation piece is really just the government trying to give you a little bit of a break, knowing that you have ongoing maintenance costs, you have ongoing replacement costs. And so they're giving you a way to shelter a tiny bit of this income by depreciating it off of your positive cash flow at the end of the year and reducing your tax burden. And that's the beauty of cost segregation, because we can take what little bit they've given us and magnify it and front load it so that you really get a huge benefit out of it initially.
Okay. So it's really the government's way to try to help the investor for some of these unforeseen costs that may come up with just general maintenance.
Exactly.
Okay. Excellent. And when you're talking about front loading it, I mentioned this in the introduction. Sometimes that front load can be quite sizable. I mean, we've had deals where somebody invests, for example, 100,000, and the write-off is that for them. They write off 100,000 year one.
Yeah, it can be extremely beneficial, especially right now, because President Trump in 2017 passed the Tax Cuts and Jobs Act of 2017. And what that did was put into place a law that says any property that's acquired or built after September 28th of 2017 qualifies for 100% bonus depreciation. Bonus depreciation means that we talked about the 5-year, the 7-year, and the 15-year that can be accelerated. 100% bonus depreciation says that any depreciable asset that has a depreciation life of 20 years or less can be taken off 100% in the first year that the study is done. So you see the benefit of accelerating part of your asset over 5 years, over 7, over 15, and the front loading of the 200% and the 150% declining balance. But now this 100% bonus depreciation is phenomenal because it takes 100% of all 5-year, all 7-year, and all 15-year values, and you can write them off in the very first year. And the beauty of this is that, of course, once you write down to zero, you can't create negative income. But if you have depreciation left over because your cash flow wasn't so wonderful in year one or year two, any remaining depreciation that's not used to write your net income down to zero can be carried forward for use in future years to defray income for up to 20 years. Now, practically, that's not going to happen. You're going to eat that up over a few years, but it's not as though you're losing any ground there. You can take what you need in the first year. If there's leftover, you carry it forward to year 2, year 3, et cetera.
Excellent. And this is maybe getting more to the CPA realm, but let me ask you this. If somebody's a W-2 income receiver and they get a K-1 that shows this tax loss, can they take advantage of that?
Disclaimer to let me emphasize what you just said. That is a CPA realm. Everyone's tax situation is slightly different, but in general, the answer is absolutely. The losses that can be shown or the depreciation that can be shown on the K1 can inure through to your personal return as well. So you get a significant benefit from that. Everyone's situation is slightly different. You have to refer to your tax professional or CPA to determine that for certain. But we see 9 times out of 10, 95 times out of 100 that that's the case.
Yes. And I've seen, in our investor base, many of them are W-2 earners. I've seen situations where that is not the case, where they cannot use that loss, that K1 loss, against their W-2 income or 1099 income. So just check with your CPA. There may be ways to use that, but that is something to consider that you can take advantage of if you are a W-2 or 1099 income generator. So let me ask you this. When is the best time to do a cost segregation study?
There's never a bad time to do a cost segregation study. It's never too late, but let me take you through a couple of scenarios. The very best time to do it is in the very first year that you own the asset. Whether you buy it in January of a year or you buy it in December of the year, you're going to have to file a tax return on it. Cost segregation is the IRS preferred methodology for depreciating an asset, but they will never tell you that specifically because it lets you keep more of your money. They want you to use straight line depreciation, which is just standard depreciation that everyone's familiar with, 1/27th and a half if it's multifamily per year. If you don't do cost segregation in the year that you purchase the property, and then you file your income tax returns for that year, if you then want to do cost segregation subsequent to that, you can do it. It's called a look back study. We can go back, even if it's 3, 4, 5 years later, we can go back and capture the additional depreciation that you should have been taking. And all of that depreciation can be utilized in the year that we do the study. So there's no penalty per se. However, since you have already filed your taxes with straight line depreciation, the IRS requires that you file a Form 3115, which is an automatic consent form and notification to the IRS that you're changing your depreciation model from the straight line methodology to the cost segregation methodology. This can be a 30 to 40 page form, and your CPA or tax professional is going to have to file that for you. And unless you have a very unusual relationship with that individual, they're going to charge you for that. We see fees starting around $700-800 if the CPA is very familiar with how to do the form, up to $2,000 or $3,000 to file that form if they have a steep learning curve and have to go in and really determine from scratch how to fill out the Form 3115. So that's the only caveat that I would say. Very best time is the year that you buy the study, or at least before you file that first income tax. If you bought something in November of 22 and came to us in January of 23, we can still do it because obviously you're not filing that income tax return until April or maybe even later if you extend. So there's a little bit of time slush there, but it's all geared on when you file your first income tax return for that asset. Knowing what I said about the Form 3115, it's not a problem to do a look back study. If you've owned a property for 2, 3 years, 4 years even, or more, you're leaving a lot of money on the table by not doing a cost segregation study, and you get to take all of that depreciation from the year you bought it through whenever we do the study for you in the year that we do the study for you. So you get a huge tax write-off in that year. So be aware that it's good. We've even done studies where someone's gotten in touch with me and said, I'm selling my property, it closes in 60 days. Can I still do a cost segregation study? And the answer to that is absolutely. We can do that look back study. The thing to consider there is you're going to be getting this huge write-off at the same time that you're selling the property. And so there's some recapture concerns there with depreciation that you may write off front loaded like that. So we do have a spreadsheet developed that will allow us to determine if it makes sense monetarily to do the cost segregation study. You can tell us when you're selling and the sales price you're getting, we can plug that into our rubric and determine that, yes, let's do it, because even though you're going to have a little bit of recapture that you have to deal with, it still makes sense. It's still positive bottom line dollar value to do the cost segregation study.
Okay. Can
But
you
in some
let me stop you there, Roger, because you made a couple really important points here. Um, the one point that I want to focus on though is the recapture
Mhm.
tax, because people think, when you get this massive depreciation that you don't pay it back. This is a bonus for investing, and that's not the case. You actually have to, the tax is recaptured at the time of disposition. So can you talk about what that really is, and then that example you gave, getting a segregation study 60 days prior to selling, is really intriguing to me, because I'm trying. I think I know why, but if you could explain why that makes sense, just to our listeners.
Sure. Talking about recapture, it's not as big a problem as some people think about it. As a matter of fact, some people who have CPAs or tax professionals who are not pro cost segregation, who feel like it's just a waste of money. We're getting money now, but we're going to have to pay it all back later. They get concerned that it makes no sense to do a cost segregation study, when the reality is that if you handle your disposition properly, it can be beneficial. And by that, I mean that recapture is only assessed or incurred to the extent that real property or personal property exhibits gain. So let's say you've got your personal property, the 5-year asset, say the carpeting and the window coverings and some of your millwork and some of your appliances and those sorts of things that we've all gone and detailed out for you on the cost segregation. Let's say you own the property for 4 years, and we valued that 5-year property at $1 million, just for general terms. That would be a very large property, but it's possible. If you sell the property and you say, okay, my 5-year property that I'm selling to you was valued at $1 million, so I'm going to sell it to you for $1 million, then yes, there will absolutely be recapture, because they'll even sometimes sell it for $1 million too, because it's worth more now than it was then in terms of brand new property. But what you don't take into account there is the aging of those assets. Those assets are 5-year property for a reason. They usually have to be replaced every 5 years. So if you've owned the property for 5 years, then it's arguable that there's almost no value left in that 5-year asset. There's some intrinsic value. You've got a 5-year-old carpet on the floor, but the reality is that's going to have to be changed out very quickly. So we argue that rather than selling the carpet at the value that we placed on it when you purchased it, if you've owned it for 4 or 5 years, it's effectively completely depreciated. And so it has a very little value, 5-10% of what we had originally placed on it. So if you value it at that level when you sell, then the issue of recapture kind of goes away. You want to push as much of your profit into the long life pieces, the 27.5-year building structure and roof and things, and especially the land, the appreciation of the land, because that will shelter your realized depreciation and reduce any concerns about recapture. So that's why I say, even if you're going to sell, if you've owned it for several years, we can make the argument that your short life piece, your personal property, the 1245 property, has virtually depreciated to a tiny percentage of what it was worth when you bought the property. And that shields you from the recapture to a certain extent.
Okay, so let me try to summarize this, and you tell me if I understand it correctly. So you do a cost segregation study at the time of acquisition or the year of acquisition. You hold a property for 5 years, and then you dispose of it in year 5. You try to focus your profit, based on sort of the accounting schemes and however the CPAs magically kind of do the returns.
Right.
They focus the proceeds on the assets like the land, the improvements, the larger improvements, the 27.5 year improvements. So it looks like capital gains rather than depreciation recapture, because the
Exactly.
capital gains is taxed at a lot lower rate than your standard depreciation recapture, and even that's even taxed lower than your profits,
Your ordinary income.
ordinary
Typically,
income.
your ordinary income is going to be at 35 to 37% tax rate. Recapture will be somewhere around 25, but your capital gains is down around 15. So there's a delta there that you want to take advantage of on the way out. And we know that legally, the seller and the buyer should agree to this distribution of 5, 7, 15, and 27.5 year property. The reality is that rarely happens. No one even thinks about it. So you, as a seller, to position yourself best with the help of your CPA and tax professional, want to do exactly what you just said, Robbie. You want to push as much of the profit that you're going to show into the land appreciation and the large improvement appreciation of buildings and that sort of infrastructure, so that you limit any kind of recapture. Now, the sooner you flip out of a property, the more you're likely to have recapture, because we haven't had time to depreciate those short life items as well. We've had a year or 18 months of depreciation, so we can still argue that they're worth less upon sale than they were when you bought it, but it's not that significant. It's not a 90 or 95% reduction. It may only be a 15 or 20% reduction. So you're going to end up with some of that recapture taxation that you're going to have to deal with. Still better than having it at 37% or 35% normal income level, but
Yes, absolutely.
not as appealing as a capital gain.
So the example that you gave us, where you performed a cost segregation study 60 days prior to that closing, do you remember how much savings that this particular person had with the cost seg versus not doing the cost segregation?
I don't remember specifically. I know it was in the hundreds of thousands of dollars. I know that he was very pleased, the primary investor that I interfaced with, because I think we saved, I want to say it was a little over $250,000 just by doing the cost segregation study with the right treatment of the depreciable life at the end of his ownership cycle. So it was not insubstantial. It was worth the time and trouble to get it done, for sure.
Yeah. Well, that's amazing. Let me ask you this: is there a reason not to do a cost segregation study?
Yeah, there can be. There can be. One of the reasons I alluded to in prior comment is that that you bought it and you're going to flip it right away. You bought it, and before you could even close on the property, you had someone who had come to you and made you a ridiculous offer that was going to make you a lot of cash if you flipped it to him. And so going in, you're going to own it for 6 months, 9 months, or a year. Then it really doesn't make much sense. We'll still look at it for you. And I keep saying we. When I say we, I'm talking about any reputable cost segregation firm. Mine, I would love to work with all of you, of course, but there are lots of very quality competitors of mine across the country. So when I say things like we, it typically holds true for any legitimate, good quality competitor. What we would do is, if you come to me and you say, Roger, I've got a deal, but I know I'm going to be out of it in 9 months, or I've got a sales contract that 12 months after I buy it, I'm going to be out of it because I'm going to be able to make $1.3 million on this quick turn. And I'm going to do that. I want that cash. Does it make sense to do cost segregation? I can perform for you a free, no obligation preliminary analysis that will include that exit strategy and determine whether or not it makes sense. I'll estimate what we think we would find in the cost segregation study. We've done over 10,000 of these studies over the last 17 years. So we have a pretty good idea, based on a description of your asset, what we're likely to find. So we'll look at a conservative amount that we'll likely find. We'll then take your information of what you pay for it, what you're going to sell it for, and when you're going to sell it, and put that into the calculation. And we can tell you with reasonable assurance, yes, it makes sense to do cost segregation. You're going to add $100,000 to your $1.3 million profit if you do cost segregation. Or conversely, and we do find this sometimes, No, it really doesn't, because by the time you've paid me to do the study and you've jumped through all the hoops that we need to do to get the study done, it's only going to put 10 grand on your bottom line. It's just not really worth the time and effort to make it happen. We don't see that too often, but there are times. I've been with this company for 16, 17 years now, and I have on multiple occasions said to a client, gee, I'd love to take your money for the study, but this really doesn't make sense at this point. This is what happens more frequently in very small investments. If you're buying a 30 unit or a 50 unit property, just because of the dollars involved. If you're buying a 200, 400, 500 unit property and you're spending 10, 13, 15 million dollars, it almost always makes sense to do the cost segregation, but not always. It does depend on each situation. That's why I have the preliminary analysis tool and the exit strategy tool to determine if there's going to be enough recapture that it's going to make it a wash or not feasible to do it.
Got it. Yeah, and that you just led into my next question is what's the minimum number of units you think it makes sense to do a cost segregation?
Yeah. And that totally depends on the price, because what we do is we take your purchase price, we subtract out a value for the land because land is not depreciable, and then the remainder is a depreciable basis. And so it depends on that depreciable basis. What we find, because of our pricing model that we've been able to put into effect, we find that if your depreciable basis is a minimum of $500,000, that almost always works. In other words, the benefit I can give to you in tax savings in year one will pay you multiples of our study fee in real life dollars. And that's why I love to do that preliminary analysis, because I can show someone before they ever obligate themselves for the study, look, it's likely that you're going to pay me $5,000 for the study, and I think I'm going to save you $22,000 in the very first year that you use our study. And that's without bonus depreciation. That was pre-2017. With bonus depreciation, gosh, Robbie, it's not unusual. I just did a prelim yesterday for one of my good clients who's buying a $23 million asset. And I anticipate finding over $3 million in additional depreciation, saving him over $1 million in bottom line taxes in year one.
Well, that's amazing. So I guess, the answer is really most properties that are larger in size, certain value will benefit from a cost segregation study.
Yeah.
And you mentioned bonus depreciation a few times. And you described what it is to some extent, but just so for the listener's sake, can you describe the bonus depreciation part one more time? And it is being phased out. So can you talk a little bit about that as well?
Correct. Yes, indeed. It's a law. And so it's written by our wonderful Congress. And so I say that tongue in cheek, but I say that as just to let you know that it can change at any time. The current law, the way it's written, the 2017 Tax Cuts and Jobs Act, says that the 100% bonus depreciation was in vogue from September 28th, 2017, and sunsets at December 31st, 2022, this year. The 100% bonus depreciation is done as of that date, the way the law is written right now. Not all bad news, however, because the way the law is written right now, 2023 has bonus depreciation, but at 80% instead of 100%. So 80% of anything identified as a 20-year depreciable life or less you can get 80% of that value in year one, and then the rest moves into just the subsequent years. That's for 2023. For 2024, it drops to 60%. 2025, it drops to 40. 2026, it drops to 20. And then in 2027, January 1, 2027, it completely sunsets and goes away. That's if the law is allowed to do the way it's written right now. With the current Congress that we have in power, who knows? That may be something that's just forgotten and they let it go. Somebody may decide that that's a terrible way to let rich people get over on the poor people, and we're going to stop that tomorrow as soon as we can. It's not, there's no talk in Washington. There's no inkling that anything's going to be done about it, but that can change moment to moment. So I guess the bottom line to know here is that even though the 100% bonus depreciation ends at the end of this year, the way the law is currently written, if it doesn't change, there will be opportunity for bonus depreciation, significant opportunity next year, and then 60% the year after, and slowly diminishing 20% per year until it goes away completely at the end of 2026.
So in essence, you will still be able to depreciate these assets, but just not in the first year. It would be the
Correct.
5-year period, the 7-year period, the 50.
Right. You would get, like, for instance, next year you would depreciate 80% of it in year one, and then the remaining 20% would be done over year 2, 3, 4, 5.
Right.
So you're going to, as each year passes, you have a little bit less or a diminution of your ability to significantly pop it in year one, but you'll still get it over the 5, 7, and 15.
Okay. And then the overarching reason for this change was it just the loss of taxes that the government could collect? I mean, is that primary reason?
The original bill was done as an incentive, frankly, for investment.
Right.
And that was the whole idea. We're going to give you these great tax breaks because we want to jumpstart our economy. We want to get back to churning these deals, building new units, whatever we need to do. And then we're going to slowly phase it out after the 5-year period's over and moving on down. There was a very different outlook in Washington, D.C. in 2017 and 2018 than there is currently. So I'm trying very hard not to be political here, but the reality is, if there's a Democratic-controlled Congress, it's much more likely to be less investor-friendly than a Republican-controlled Congress. Not an absolute, of course, but that's just what we've seen over the years. As the more conservative regimes come in, it's more favorable for the investor and the business in general, in my opinion. And as the more liberal come in, it diminishes that return to a certain extent. Again, I don't have any inclination or knowledge of anything that's going on right now in Congress that's going to change that. So we should still plan on having that available. But the sooner you can take advantage of it, the better, from a hard number sense and just from the risk of possibility of change.
Okay. And then I'll ask you one more question, Roger, then we'll open it up to the audience here. But there are many companies that perform these cost segregation studies. What is the difference between them? Because we've had several bids at times when we're looking for a particular company, and you guys were always, you're highlighted amongst a lot of others by multiple people that we knew. But what's the difference between them? Because we did have different proposals, different amounts that we were able to write off year one. It changed from firm to firm.
Yeah, and it will. I will say this: a good, reputable cost segregation firm, the deviation in findings should be minimal. Should be 1-2%. Should be very, very small. They have to know what they're doing. There's a lot of I won't call them mom and pop cost segregation firms out there, but there are a lot of small cost segregation firms that will promise you a lot, and sometimes they can't deliver. Sometimes they do deliver, but their rationale is off, and their understanding of the laws can be off a little bit, and so their numbers look great, but if you're ever audited by the IRS, that could be an issue. Gosh, there's a lot to unpack here. Let me say that we have, as I mentioned earlier, we have a great number. I shouldn't say that. A handful, 6, 8, 10 firms that I can think of that do great work and that are going to find very similar findings to us. And the differentiation you would have to make between those, it's not really going to impact your bottom line that much because the findings are going to be so similar. The cost factor may be different because they may approach things from a different angle. And by that, I mean that the IRS does not specify who's capable of doing a cost segregation service or study other than in very general terms. It needs to be someone who's knowledgeable in accounting, someone who's knowledgeable about building and in the construction industry, and someone who's knowledgeable about the laws. That's essentially what they say. Some of our good competitors are engineering firms, and they tout that they have licensed, degreed engineers who go out and do these studies. And they do the studies, and they do them very well. They may charge you 25 or 30% more than we do because we use appraisers. And we think appraisers have a better base of knowledge than engineers. The engineers can probably tell you all the little details, how many screws, how many nails, how many lineal feet of electrical wiring, et cetera, needed to go into this study and what was built when these buildings were put together. The reality is that really doesn't matter that much because those items are not depreciable. They're not short-term depreciable. They're the long-term depreciable. So we focus on the short-term, the 5, 7, 15 year that we've mentioned in passing before, and we get detail on those. Our appraisers can go out. They know the construction industry. They know real estate industry in general much better than most engineers do. And the other key factor, the reason we love using appraisers, is that when you buy an asset, a pre-existing asset that is not a new construction, it's not a new construction. So there's age factors that have to be taken into consideration. An engineer has some inkling of how to age an asset properly, but an appraiser, that is exactly what they do every day, is they look at an item, they value it based on being able to age appropriately. And so that's why we feel that we can do as good a job as any engineer firm. And because our licensed appraisers are a little bit less expensive to hire than someone with a mechanical engineering degree, we are able to reduce our price point to make it more affordable for smaller investors and to give you a better ROI, essentially, on the positive results you're going to get from the study versus the cost you pay for the study.
Absolutely.
So that's kind of a background of why you might get a different feel. Here's the thing. The most important thing, honestly, if I'm an investor and I'm going to hire a cost segregation firm, I want to know that they're good to start with. But I've already said, not only are we good, but also those other guys are good as well. We've got lots of good competitors out there. But I also want to know they're going to stand behind their study in case the IRS does have any questions.
Exactly.
Our study comes with no additional charge, a lifetime warranty for the lifetime of your ownership of the asset. If at any time the IRS reviews your financials and sees the cost segregation study and has a question about why something was done on the cost segregation study, we will interface directly with the IRS. We will talk with them on the phone, exchange emails, write white papers, up to and including being expert witness in federal tax court if necessary, at no additional charge, because we feel that strongly about our studies. We are I guess, belt and suspenders type company. We don't want our pants on the ground. So we're going to find every single deduction that we can get for you, that we can accelerate depreciation on. But we're not going to push into areas where the IRS has not said, yes, this is okay. We're not a gray oriented company. We're black and white. So you can rest assured that our results will stand the test of time. I mentioned earlier that we've done over 10,000 studies. In that entire time, our 17 years of doing cost segregation, we've been asked to interface with the IRS on 13 studies. Now, that doesn't mean that there were only 13 audits or that people had 13 studies that had questions. But one of the things that we also provide in our study is an appendix from the IRS own documentation that calls out chapter and verse of why we made the decisions we made in the cost segregation study. So I imagine there have been a whole lot more than 13 times that the IRS has looked at one of our studies. But if they just look at that appendix, it cites exactly from their own laws and regulations why we've done what we've done. And they say, oh, all right, I get it now.
Excellent.
Also, I'll add on those 13 times that we've had to interface with the IRS to defend our study, we have been 100% successful. We've never had to change a single line item on any of our studies.
Oh, that's amazing. That's a great statistic. Thanks for
It
sharing
truly
that.
is. Yep.
All right, let's jump to the questions. The first one is from Dr. Shilpi Pradhan here. It says, does a property have to be in an LLC, or can it be in your name to take depreciation or bonus depreciation?
Great question, Doctor. There's no requisite law that it has to be set up in any particular form of organization. We can do LLCs, we can do TICs, we can do sole proprietorships, we can do individual owners. It doesn't matter. We do cost segregation studies for Bob Smith down the road that owns a duplex that he rents out. Those weren't always financially feasible, but with the 100% bonus depreciation, we can get him back 25, 30, 40% of what he paid for the property in the first year in terms of additional depreciation. So the answer is, matters not how it's set up, what the ownership entity is, as long as it's a for-profit commercial venture, then we can do a cost segregation study, or it's eligible for a cost segregation study.
Okay, excellent. Thank you. And then another question. What happens to the unclaimed losses at the time of sale, especially when someone's doing a 1031 exchange? Are the losses surrendered, or do they have implications on the new property?
They have implications on the new property. It impacts the value. For instance, if you've got a property that you've depreciated to a certain extent, then you can't double dip. You can't exchange into a new property and start the clock completely over. You've got to acknowledge that depreciation that you've already used. We do 1031 exchange cost segregation studies all the time. It's certainly still feasible, but where you might have exchanged in, a $3 million property, after cost segregation, you may only be able to value that at $2.5 million or whatever the numbers work out to be. So there is an impact, but it's not severe typically. And we've been able to do cost segregation studies on new 1031 acquisitions when you've traded in a property that's valued at $5 million and your new asset's only $5.5 million. That $500,000 delta is enough for us to get the study done. So there is an impact, but it's not injurious necessarily. Well, we can look at that for you with that preliminary analysis, as long as you make sure and let us know that it's a 1031 exchange situation.
So if it is a 1031 exchange situation, you have some depreciation that you're carrying over to the new asset, and then you perform another cost segregation. Basically, you're going to take the delta of the depreciation you're carrying over, and then the new depreciation that you can acquire with the new property.
Exactly. Okay. So it diminishes the effectiveness, but it does not eliminate it.
Okay. Excellent. Got it. If anybody has any more questions, put them in the chat, please. I have one sort of maybe just a curiosity, is why the 27.5 years? That's just a sort of seems like a random.
That question, I've asked that question myself. I'm sure there was a rationale for it. It's very bizarre that they chose 27.5 years. And what's even stranger is when you get my preliminary analysis that I'll do for you, you're going to look at my spreadsheet, because what the preliminary analysis does is it gives you a spreadsheet that tells you, okay, here's your first year impact. And then a second spreadsheet that shows a net present value calculation. The left-hand side will show depreciation via straight line. The middle sections will show anticipated depreciation with cost segregation. The right-hand side will show the difference between those two. And then a net present value, typically calculated at a 5% discount, that shows today's value of money versus what it's going to be in the future. But for your multifamily assets, it's going to show 30 years, not 28 years, not 27.5, because the first year you'll typically get a half year of depreciation, and your last year you'll get a half year. So it's really nonsensical. I've never been given a specific reason why 27.5 years for residential versus the 39 year for commercial. Just be happy that we get to write it off quicker.
Right, exactly. Okay, well, on that note, thank you, Roger. This was incredibly helpful. You
Sure.
really presented us with an immense amount of knowledge here about cost segregation, rapid depreciation. I'm sure our listeners got a ton out of it. Really
I hope
appreciate your
so.
time.
I hope so. Yeah, absolutely. And certainly feel free to reach out to me. You guys at Viking have my contact information. So if anyone needs me, I'm more than happy to provide the free preliminary analysis or answer any other questions that you might have.
How can folks reach out to you?
Probably the best way is via email, and that's rhibbs, RHIBBS, at the @ sign POconnor.com, POCONNOR.com. I also have a website, expertcostseg.com, which will answer a lot of your questions. And we'll also have a calculator that will give you a very rough preliminary analysis. And then you can reach out to me and I can refine that for you. If it's midnight and you can't sleep because you're thinking about your investments, pop over to expertcostseg.com and it'll walk you through a lot of frequently asked questions as well as giving you the chance to do your own rough preliminary analysis.
Okay, and that may help you sleep.
Yeah, there you go.
I'm gonna do that.
Yeah, I've made my website as boring as possible, so it gets you to sleep.
Excellent. Well, thank you so much. Appreciate your time.
You're very welcome. Take care, guys. Good luck on your investments.
Thank you.